Hey guys, thanks for tuning in. So in today's video, we're going to talk about Total Energies. This is an energy stock that I have researched in the past couple of days, and I've come to the conclusion that this is a stock that I want to invest in, and I'll explain the reasons why. And so, just to give a little bit of background on on this research, I was looking for some stocks to invest in because it's been a little bit more difficult to find good deals in the market right now. We're in 2020 of August, and we've been through about 18 months of this coronavirus, and the market obviously did fell 30, 40, 50% in 2020, and then it came back 50%, and then it's just continuously gone up. And so the higher it goes up, it's become slightly bit more difficult to find good opportunities. And so this is a stock that I came about by just kind of narrowing down or changing my investment strategy, where I'm basically building a portfolio of 10 stocks within 10 different industries. And when I researched the energy stocks, this was a company that really stood out to me. So just a little bit of an introduction, so you guys have some background and context on how I came about this stock. So let's get straight to it. We're going to cover a lot of information. So hopefully, you have some notes, and if you have any questions, please feel free to leave questions down below on anything that I might miss. So the first thing I looked at here was I just went straight to the statistics, and I got a sense of how this company is performing, and it looks like this company has a P ratio of about 18 times compared to the industry of 54 to almost 50. And that to me tells me this stock could potentially be undervalued based on the P ratio. But another metric that I looked at was this PEG ratio here. And this PEG ratio basically tells you how the company is performing based relative to the growth expectations. This company has a PEG ratio of 0.55. Now, typically, stocks with PEG ratio of 0.5 or less typically are companies that are in distress. And so that was interesting to me because the PEG ratio for the industry is 1. And so, I think this could be a good opportunity given the fact that, maybe the industry or the company is going through some distress, and maybe there's some good value here. So the next thing I looked at was price to cash flow, trailing 12 month of 6 compared to the industry of 35. I mean, again, this is another green flag for me because it means I'm paying less for the amount of cash flow this company is generating. The next metric I looked at was price to sales. So again, price to sales is also really good. The company is making sales, and you're paying a low price for it compared to the industry of 4.7. And then, you can look at price to book. This kind of gives you an idea of how the price is trading based on the book value of the company. And it happens to be lower than the industry. So based on the metrics here, this is potentially an undervalued stock with pretty good growth, in my opinion, based on this PEG ratio. But again, we want to figure out whether this is a distressed metric or this is a very good growth metric. And we're not able to figure that out with this data yet, so let's keep looking. The next metrics I looked at was the growth. So the first thing I looked at was, what is the revenue growth in the last 5 years? And this company is negative 3.55%. So it's actually worse than the industry average. But what really catches my eye here is this forward earnings per share long-term growth from 3 to 4. And you see that this stock is expected to have an earnings per share growth rate of 34% within the next 3 to 5 years. If you compare that to the industry is expected to get 60%. So now I'm starting to get a little bit more color on this picture, and this potentially is a pretty good distress investment strategy here. And again, projected earnings per share growth rate next year versus this year is 6% compared to the industry average. So really what I'm looking at here is this forward earnings per share growth rate 3 to 5 years of 34%. And you can see, revenue change this last quarter versus same quarter prior year. We had a really strong revenue growth of 93%. And I think largely this negative revenue growth is largely due to 2020, where we went through the pandemic and everything went down. We all went and shut down. The supply for, or the demand for oil was completely shut down. There was, the oil prices dropped to about negative and then came back up. So, this negative number here is not I don't think it's a true representation of how the company does when we're not in the pandemic. I think it's largely influenced by the pandemic, and so I think this is a good opportunity. And I'll explain. We can look at the financial statements to view what the sales growth was. Okay, so free cash flow. I mean, we got plenty of cash flow coming in. Cash flow growth rate negative 20% the last 5 years, so that's a red flag, obviously. But here's one thing that I'm really happy to see is the pre-tax margin. So the company is profiting about 7% pre-tax compared to the industry of negative 12%. So this is a profitable company. And so, that gives me a little bit more comfort to be able to invest in this company, knowing that they're making profit. If we look at returns, return on equity is higher than the industry average. Return on assets is also higher than the industry average. So pretty good return metrics here. In terms of debt, this is a company I can get really comfortable with because they don't have a lot of debt. You see here they have about 27% debt to asset ratio, and they have a current ratio of 1.2. So they have plenty of cash to be able to meet their short-term financial obligations. So I really like this company so far. Let's take a look at the financial statements. And let's figure out what's going on with their sales and their profit margins. So I'm looking at this income statement here. And basically I see in 2016, the company did $127 billion in sales. And then in 2017, they went up to $149 billion in sales. Again, 2018, they did even better. They did 184, and then in 2019, their sales decreased. So it'd be interesting to know the demand and why they had lower sales in 2019. And of course, obviously in 2020, they reported $119 billion in sales. So obviously a huge decrease in sales. But again, they were on track to increase sales from 2016 for 3 straight years. And then they had some sort of hiccup where they had less sales. Profit margins, we can look at this and say, okay, they did $5.9 billion in net profit. So if we did a quick calculation here, we can see that, we take the 5.9 billion divided by the 127, it's a 4% profit margin. And let's take a look at 2018 revenue. We did 11.1 billion divided by 184 billion. That's almost a 6% profit margin. So margins went up from 2016 to 2017. So that's a good indicator. It'd be interesting to know what happened in 2019. And let's just take a look at the profit margin for 2019. We had $10 billion of net income. We'll divide that by $176 billion. We had about a 5.6 profit margin in 2019. So it's still pretty good. It's better than 2016. So I can get comfortable with that. The other metric I was going to look at is the asset turnover. And the asset turnover ratio tells you how efficient this company is operating. And I can do the calculation here. So we'll take the sales in 2020. We can even take the sales of 2019. It just gives you a better picture without the pandemic distortion. So let's look at sales asset turnover, which is going to be sales. We'll do $176 billion. And we're going to divide that by the total assets the company has in its balance sheet. And they have $266 billion worth of assets. So let's just do that math, divided by the assets, and we get a 0.6. Or it should really be 273. So it's close enough. So we're about a 0.6 asset turnover. And, one of the things I do with this ratio is I compare it to some of the competitors. And I can show you the calculations I did here when I was doing my research. It's actually not going to be in the spreadsheet, but I can tell you that, the asset turnover ratio for this company compared to ExxonMobil and Chevron was actually better than Chevron, but not better than Exxon. So it was kind of in the middle between these two. So you had ExxonMobil, which had the best asset turnover, and then you had Total Energies, and then you had Chevron. But again, I feel good about Total Energies because Total Energies only decreased sales -3%, compared to Exxon. They decreased about 5%, and I think either Exxon or Chevron, they had sales decrease of 5 to 7% negative, and so I felt, in terms of sales growth, I thought Total Energies was the best company. Um, okay, so those are some of the metrics I look at. Uh, some other things I might look at are the current news, just to get a flavor of what's going on with the current market and as it relates to the stock. And there was one comment here that really stood out to me, and it was this CFRA maintains strong buy opinion by Total Energies. And what they're saying here is basically that they have a price target of, I believe it was, let's see here, we keep our target price of ADRS shares to $54, and you can see the current price is selling at 54. So this analyst, is forecasting this stock price to be about $54, and he believes that there is some, undervaluation going on with it as it pertains to this stock. And so that gives my research assurance that what I'm analyzing is correct. Obviously, it has a very bullish score here, so that just gives me more assurance of my research. And the last thing I look at is really sort of the research reports, and I try to get as much flavor as to what are the analysts saying about this stock. And a good resource I like is the Zacks Research. They do a lot of good reports. So it looks like they have a 3-hold. I used to be able to see if it was a strong buy or not, but looks like it's a hold. Maybe not. Okay, so ADR shares. This company is pretty good. I remember seeing there was a report, and maybe they took it down. But there was a report that said this company was doing pretty good. Oh, maybe it's this one here, investment research. Okay, here we go. All right, so this report basically says, let's see what is their recommendation. I'll zoom in here so you can get a better look, and we'll see here. Okay, so over the past 5 years, this stock has traded as high as 9. Our neutral recommendation indicates that this stock will perform in line with the market. Our 51 price target reflects such cash flow, and they feel pretty good about this. They think this stock will do just about as good as the market. So again, it's up to you to make the determination whether you buy what they're saying, or based on your research, you feel different that this company will do better. I personally think this company will outperform, and so I think it's a good investment pick as well. All right, well, thanks for tuning in, and if you have any questions, please feel free to leave a comment down below, and looking forward to speaking to you in the next video. Thank you.